Hi, welcome to the famous Home Depot backyard, the one that I said are spending so much time at Home Depot that they'll beat. And actually they did on earnings. Actually also Home Depot did outperform Walmart last week, but I'm not here to talk about dodgy retail calls that just about eked out a 1.5% profit last week. This week's tough again because we've got the debt ceiling negotiation, which my guy in Washington, who sometimes gets it completely wrong, but he says this one's going to definitely go to the wire. He says that they start by agreeing on the small stuff, and then as they escalate the negotiations, they begin to disagree more and more, and that's essentially where we're at. So that's going to be a major overhang on the market alongside any sort of inflation data that we'll get later in the week. And obviously the market's had a good run here year to date. The Nasdaq's in full-scale bull territory. And that obviously presents a risk with sell in May combined with the debt ceiling negotiation deadline 1st of June. We've also got an OPEC meeting upcoming, but I feel like OPEC's credibility is kind of shot here because it's so dependent on what comes out of the Russians, and I just don't know how well truly the Russians and the Saudis get on. Certainly they don't at the oil minister level. And so whatever comes out of this upcoming OPEC meeting next week, I don't know how much it's really going to affect the market, which essentially is the oil market, which essentially is in equilibrium. It's just sort of balanced at the moment, but it's at a time of year, as I keep saying, that it should be bullish. We should be acting a lot better here if we were in a bull market. And as it is, we're just sort of noodling around as US refining utilization keeps coming on pretty strongly. The inventory data is kind of okay. The concern is that the arbitrage for exporting product from Europe into New York Harbor is very wide, and so you're probably going to see refining margins get hit by a surge of gasoline imports into New York Harbor. Stay tuned for that. And so we're somewhat concerned about refining. Obviously they're fairly cheap, and there's definitely been a sell-off pertaining to the potential for an upcoming recession. So refining is sort of balanced, and that's the problem with all the oils. We're sort of balanced. There's nothing calamitously bad out there, a bit like the Chevron for PDCE deal. It's kind of fine, it's like, okay, great, but it doesn't make you want to run out and buy Chevron, and the valuation of PDCE doesn't make you want to run out and buy smaller cap oils. So we're sort of stuck where we're at, waiting for the breakout. Now, of course, people's balances look very good for the second half. I'm nervous about that call. For a start, that's a can that's been kicked for 6 months at least by the bulls. So, they were bullish like I was late last year, but we abandoned the bull call pretty quickly this year when basically Russian exports failed to temper as fast as we thought through really March. And the demand side, we were always somewhat skeptical, as we thought that the US distillate weakness would actually be a bigger deal than it is, because although there's been distillate weakness, we didn't anticipate the strength we've seen in US gasoline. So that's kind of left us neutral on the US market. And then you could argue about China, but what I said last week is that the nature of China's economic recovery is very service-led, and that's not that bullish for oil, with the growth in exports being, that's Athena, with the growth in exports being dominated by oil products. It's not that much of a net bullish thing. So anyway, we hit Memorial Day, which is traditionally for me the most bullish point of the year, the high point of the year for oil this week, and it's going to be like a 75 at best, which is a good oil price. It's okay, it's fine, but it's just not a thriller to really want to go out there and start, as the old oil service analysts used to say, pounding both shoes on the table. And that's where we are today. We'll see what happens with the debt ceiling. I think it'll go to the wire. So I think this week we're shorting stuff actually, and we're long the VIX, and that's basically the expectation that there's no way these Muppets will quickly agree a deal and walk out shaking hands. They're definitely going to game each other right to the margin, which will be right through Memorial Day weekend. So good luck with that. The market's just noodling around today, and I think it'll continue doing that until we get more evidence that the debt ceiling negotiations are going to go to the wire, at which point the market will start trading off. The other really big thing this week, obviously, is Nvidia earnings. I've argued that essentially the future upside from AI is so unknown that the near-term earnings of Nvidia don't really make much difference. But of course, if things come in weak, for example, in terms of the order book and the guidance for this year, that's going to have a major effect on the stock, insofar as that then affects the whole major long-term outlook that it's currently pricing at, whatever it's at, 30 times sales. So big earnings from Nvidia this week, and that'll be the other thing to watch for alongside the inflation data and the dreaded debt ceiling negotiations. Have a good week.